this stuff may already make sense to you with where you're at, and then some of the stuff may be new. I've tried to design this in a way where it's broad, where we can kind of meet people where they're at, but there's many different areas that we can certainly elaborate on as well. And this is kind of this is one of the first series here in multiple series that I'm hoping to put on, and this will just essentially lay the foundation of strategy development. And what are those components of strategy development? What's the differences between someone who is a retail trader versus a professional trader? And once we kind of lay that foundation, there'll be some additional webinars I plan to put on where we'll start to talk more about the technical pieces of it, such as like statistical significance of backtesting and optimization and walk forward optimization, and kind of building upon this in future webinars. Can you see my screen okay?
Yeah. All
right. So what we're going to go through today are many different topics. We'll go through the differences between retail and professional trading. What is a playbook? We're going to talk about the different types of strategies and what those different subcomponents are of those strategies. We'll start to talk about finding edge that resonates with your psychology and how to essentially identify where that edge is and build upon what's working. We're going to speak through and talk through filters, triggers, risk management. I'm going to provide some examples on how to leverage Monte Carlo simulations and the importance of that. We're going to talk a little bit about trade management, and there's many different pieces we can touch on here. So as we get into these different topics, if you want to dive into one of these more specifically, just let me know and we can kind of go down that direction where you'll find some value here. So the first thing that I wanted to share is just kind of that learning curve of a professional trader versus a retail trader, and what are those differences. And I'm sure much of this can resonate with you. Many of us are somewhere in between. So if we look at those habits and traits of a retail trader, many of them, they don't have any plans, they're stressed out, they're gambling. And a lot of this comes down to not taking full responsibility for their outcomes. A lot of retail traders like to blame things that are outside of themselves on why they weren't successful, why they lost trades, why they're not making money, so on and so forth. One of the key differences between that retail trader and professional trader is really just taking full responsibility. It's not looking outwards and saying that my outcome is because the market makers had it in for me, or there was a big person on the other side of this trade who wiped me out. Whenever anybody is using that kind of context and thought process, they are disempowering themselves. When someone takes full responsibility for their outcome and doesn't put that outcome on somebody else, they're really able to start to make a change. And that's one big thing that I see between professional traders and retail traders is taking that full responsibility. And what does this mean? It really means taking the time to manage your trading journal, which is going to help you reduce your stress. It's going to give you more confidence. And really, it's spending more time working on the business than in the business. And I see many parallels to other businesses, like some blue-collar businesses, for example, where maybe you have a plumber who's working in the business and he's running calls, and when you are working in the business isn't going to improve itself. It's not going to grow because your focus is not on growing the business. So a lot of times, and I know for myself as well, I spend more time, energy, and effort outside of the market, quantifying my edges, doing my analysis, doing my research, and I am fully prepared going into the market, knowing exactly when I'm going to execute, why I'm going to execute, and I'm taking all of that prep work and bringing it into game day, essentially. That's one of the big differences. So I would say I probably spend 80% of the time out of the market working on my systems and 20% in the market. The other key difference is professional traders typically have a playbook. This could be something that's written on a piece of paper. It could be something that's drafted out in Word or various other mediums. But essentially, a playbook for a trader is going to define all of the different strategies they're willing to take. And what are all those rules? What are those parameters? And this applies to both discretionary traders, systematic traders, automated traders. It's something that clearly defines every aspect of their strategy. With a lot of retail traders, I see they'll jump in to a trade whenever they feel like it's a good opportunity, and they're making their decisions based on those feelings. When you look at someone who is a much more mature trader, they have those rules in place, and that is the framework that they operate within. Many people talk about self-discipline being the issue with their trading. Like, I really need to work on my self-discipline, but what they don't realize is they don't have any framework to even follow to measure their discipline. So kind of step one is creating that framework that you operate in. The market is completely random, and so it's something that you have to create your rules and your frameworks and your laws, essentially, that you're going to follow. And once you have that in place, then you can start to measure, hey, do I have self-discipline? And that's measured by looking at how well can I follow my plan, as an example. So until you're able to define everything clearly, you really can't improve as a trader without taking the time to document, to define, and then you can measure against that framework that you create. So when we look at a trader's playbook, this is just an example of different strategies. So each one of these stacked bars is essentially a strategy. And what I'm trying to convey here is that there's many times multiple strategies in a playbook, and each one of those strategies has four main components. One's a risk management, one's a trade management, and then there's typically filters and triggers on those strategies. This is something that the size of these bars are reflecting the importance of those components. And something else that traders typically think through is also managing risk across those strategies as well. So it's not just managing this risk in this one particular strategy, it's managing that risk horizontally as well. When we break it down to its most simple components, and I'm sure you're pretty aware with this one here, there's really only two types of strategies. You have momentum strategies and you have mean reversion strategies. Pretty much every strategy out there can be classified and boiled down to these two types. Examples of your momentum strategy would be trend following, breakout, or momentum strategies. Mean reversion would be contrarian, counter trend, range trading, mean reversion, so on and so forth. So we have these two broad categories, and those two broad categories essentially have subcategories up underneath them. So when we start to look at the breakdown and the components of the strategies, these are also other things that traders are going to think through when they're trying to develop a strategy, and they're going to clearly document these items as they're starting to define their framework that they want to trade by or the framework that they want to test. So some of those items are, what are those time frames that the trader wants to trade? Are they going to be looking to scalp? Are they looking to trade intraday? Are they looking to swing trade? This is something that is mostly defined by someone's psychology and their availability throughout the day. If someone's always busy during the day, they're probably going to lean more towards swing trading. If someone if someone has the time to sit in front of the charts, they may lean more towards scalping. Also depends on, are they able to think very quickly or do they need time to analyze the markets? There's also some other things to think through, is like, what types of assets do you want to trade? This is very important when we start to discuss around diversification in a portfolio. Also making decisions around, do I want to have my systems trade and do some automated trading, or do I want to be a discretionary trader? There's obviously pros and cons with both directions here. Am I looking to do pattern-based strategies? Am I looking to do statistical arbitrage between ETFs or between certain pairs or other sorts of strategies here? Do I want to create strategies around events such as earnings? Do I want to get into market making? So there's all sorts of different approaches that someone can take when they want to design a strategy. So clearly defining that's very important, and that's kind of one of the first things that a lot of traders miss. They'll just hop into the market, start trading, and hope for the best. So what I'm trying to show here is that traders really should be taking the time to document these categories, and this is something that's documented for every one of those strategies, every one of those vertical strategies that I showed you previously. If you're not sure what is resonating with you, many traders don't track anything, so they have really no idea where to start. I think, Hogler, you're a little bit further ahead with what you're doing, but for those traders who don't understand what's working for them, what they want to do, then we offer an online trading journal that allows traders to upload their trades, and it allows them to understand their trading habits. They can upload all of those trades and see what's working, what's not working, and that could be a good starting point for them. In our trading journal, essentially, these are just those 4 steps for users who don't understand what they like to trade. They can export all of their trades from their broker. When they import them, they can tag those trades as mean reversion or as trending or any other tags that they want to use to segment. They can filter by those tags. And then we have custom report metrics and insights. Really, this insights here page would help a trader understand very quickly, without any sort of tagging or anything, what's specifically working for them without diving into it much deeper than that. A couple other things that traders can leverage to start to understand their habits, and that's going to help support them as they're developing strategies, is keeping a daily trade journal. So this is where they can start to document what's working well, how did they trade during the day, what were some of those challenges that they had. They can also rate their emotions for the day here, so they can start to track, hey, are my emotions impacting my P&L curve? They'll also have the ability to start to track the different news that happens during their trades, as well as the company fundamentals, so that they can start to draw correlations between any sort of news events that are impacting them, impacting their trading, I should say. So we're actually storing all of this information at the time of the trade, so that you always have a record. You can go back and analyze that as well to see, is there any sort of correlation between earnings going on when you're running certain strategies, or maybe acquisitions and mergers, or whatever the case may be. So once a trader has an understanding of the types of strategies that they are trading, or maybe they're trying to create something from scratch, it's 1, defining mean reversion momentum, 2, defining those subcategories, and then the next 2 pieces are really to sit down and figure out what filters and triggers you want to use in order for you to develop this strategy. There are many different types of filters. There's many different uses for filters. The 2 main types of filters are trend filters and oscillating filters. When you start to look at trend and oscillating filters, those are how the filters are actually applied to the data on the charts. And there are different categories of both trend filters and oscillating filters, and that's what you see on the screen. So the first one on top is a volatility filter. You can find trend filters that are for volatility. You can find oscillating filters that are for volatility. If we start to go through the rest of these are pretty important filters that I tried to highlight, and we can talk through some of these in more detail if you'd like as well. So we have volatility filters is an important one. Time of day filters, day of the week filters, strength filters, trend filters, and fundamental filters. Think of filters as a way to segment the data or segment the market, so that you can put blinders on, and you can put blinders on and you can start to analyze that data more clearly. Looks like we just had someone else join. Hey, Chris.
Hello. Hey, Chris.
So as we start to dive into these filters, I'll give a couple examples around how I leverage some of these, and hopefully this might get you thinking about how you can leverage some of these as well in your trading. And again, the intention with these is to be able to segment the market, to find data that is more structured, to find patterns that are repeating, so on and so forth. One of the main filters that I use is a time of day filter, and there's the main reason that I'm leveraging this filter is because the volatility and volume changes throughout the day. I typically trade the U.S. exchanges. So what you see on the screen here is the time across x-axis here, this is actually in Central Time. And then you can see here, I've tried to illustrate that the European exchanges and the US overlap. And this overlap here creates quite a bit of volume in our morning market. Down here, I tried to illustrate what that volume curve kind of looks like. So one thing I've noticed as I'm developing strategies is I typically always break the market into three sections. Opening section, kind of afternoon, and a close section. And the main reason for this is the volatility changes throughout the day. And we started talking about the two kind of broad categories of mean reversion versus the momentum strategies. And I have found through my own research that the type of strategy works different in different times of day. So momentum will typically work better in the opening and close, whereas mean reversion typically will work better in the afternoon. One of the insights that we provide through Market Jungle is after trades are uploaded, we do show a insight here so that if you're just uploading your trades for the entire day and you've segmented them by strategy, you can start to understand what time of day does your strategy work best and focus on that time of day that is working for you. There's also various other ways of getting this data as well. Chris, I know you're just joining us. If you have questions, you can feel free. It's only two people on the call right now, so take some time and feel free to stop me if you have questions or if you want to talk through some of these items in more detail.
Okay, thank you.
So the other type of filter that is very common is a day of week filter. And this is something that I've noticed throughout my strategy development, where I try to understand the day of the week and how those strategies are performing during the day of the week. There's also sometimes, I know we're not going to dive a lot into optimization today. That'll be a future webinar that we put on. But there's also many times where I will segment out the market just by the day of the week, and I'll start to apply my triggers and filters and everything else on that day of week. And what I tried to illustrate here is just that volatility roughly and how that changes throughout the week. And a lot of this, I think, is due to like options expiring on Fridays. And it also has to do with the weekend news being released throughout the weekend, things of that nature. So typically on like Mondays and Fridays, excuse me, you get a little bit more volatility, and Wednesday, Thursdays, you get a little bit of a lull. And so this is another way to filter out your strategies and start to understand what day of the week are they performing best. And we also provide some insights here on Market Jungle to help you divide out by the week after uploading your trades to see what's working best. And again, if you start to segment your strategies on Market Jungle, you'll be able to say, this particular strategy works best on Monday, Tuesday, Wednesday, doesn't work on Thursday, Friday, or whatever the case may be, depending on that type of strategy. Traders will take this information and they'll essentially look at where is it performing the best, where is it performing the worst, and then there's really two decisions that can be made. Either you just solely focus on what's working and stop doing what's not working, or the other option is managing your position sizing and scaling up on those days with your risk on those days that are working and scaling down on days that aren't. A couple other types of filters, and this will lead into another discussion in more detail later on about regime filters. But two other filters I want to talk about is trending, ways to classify the market as trending, or ways to classify the market as with volatility. So in this example here, what I want to show is that another way to filter the market is the market trending? Is there no trend? Is the market trending up or down, essentially? And this is just one example. There's many different ways to classify the market, but the Arun indicator is one option. There's many other options to be able to classify the market as well. And this is just one that I wanted to show as an example to talk through the context here. So with this particular example, with the Arun indicator, there's two lines. You have a green line and a blue line. And the green line, whenever it's above a certain threshold, and the blue line is below a certain threshold, you can see here we're using 70 and 30 as our examples, then technically we're considering the market as classified as trending. And then if they're flip-flopped, we consider that as, this would be an uptrend in green, red would be a downtrend, and then yellow would be no trend. And the no trend, I've just tried to highlight in between where we don't have that green line up here and the blue line down here, or vice versa. So this is just a way to start to filter the market, and we're going to get into this in more detail, but there's many reasons for doing this, and one of those is going back to kind of that where we started out about, we get mean reversion and we have trending strategies. Each of those operate in different market conditions better. Each of them operate different times of day better. And so by taking these filters and starting to segment the market out, you're able to better understand how that strategy performs in different conditions.
Question: do you find it hard to get filters that are not lagging filters? Because what I see, I look at the price action, I see, yeah, there was a trend, and that's like nice. But is it still gonna be a trend? Is it over now, or and when looking at EMAs and stuff, they tend to be lagging indicators, and I find it difficult to trust some kind of filter that could give me not lagging information, but something that is actual current or even leading.
Yeah. So that's always a challenge, and there's a whole process that I go through when looking at indicators, and that's one of those things. The indicators are really broken into two types. You have lagging indicators and you have leading indicators. And so I'm not just arbitrarily selecting an indicator and saying, yeah, let me go with this. I'm spending 20, 30, 40 hours trying to intimately understand the calculations behind those indicators, and I'm going to compare those with the charts to understand when those triggers are happening, how frequently are they happening, how much noise are in those filters. So what you see kind of on the screen here, I go through a very similar exercise as I'm reviewing those strategies, or excuse me, as I'm reviewing those indicators, and then I'm going to compare it with the chart above, and I'm going to change different time frames, I'm going to change different parameters, I'm going to work to see how often am I getting false signals, how often am I getting accurate signals, how often is this triggering when, or is this filter correct, and a leading filter will essentially pretty much line up with the start of a trend and the end of the trend. So I'm going to start to see, hey, are those zones kind of lining up with the start and end of the trend? So I'm kind of spending 30, 40 hours just on one indicator trying to look through that to figure out, one, do I have a full understanding of how it's calculated, the mathematics behind it, and then how does it work on those different time frames and in the market. And I'm not just picking an arbitrary indicator. I'm going into this with an idea around, hey, I see a particular pattern forming in the market, or I see there's something that really resonates with me that I'm seeing in the market as some opportunity. And when I'm going through this process, I'm trying to classify that opportunity to test it. So I'll go essentially reverse engineer those, where I'll go find moves that resonate with myself, and then I'll start to look at ways to start to classify that so that I can test it. Hey, Joseph. One piece that I want to show here is with leveraging Market Jungle, the tags is a really strong feature here. So one of the things that I do personally is, as I'm going through this development, when I'm uploading trades, I'll tag my trades and I'll say, hey, the market was uptrending, downtrending, or no trend. And that way in the future, as I start to manage my data, I can have those very clear insights around my strategy. So this would allow me to say, all right, I want to filter my strategy by uptrending and just see my statistics on when it's uptrending, or just see my statistics when it's not trending, or when it's downtrending, as an example. Again, it allows me to segment it so that I can look at those insights and understand where does my strategy work best. Another example of segmenting the market that's pretty important, the last one was trend. This one is volatility. This also plays a big impact on your strategies, and there are certain strategies that work really good in very volatile conditions. There's certain strategies that work much better in low volatility. So this is, again, just one example of a way to classify the price action and leveraging filters. And this is using Bollinger Bands, and it's essentially using the difference between the upper and lower Bollinger Band, as well as with a defined tolerance. So what I mean by this is, if we just take the upper band and minus the lower band, we'll have the difference, and then we can specify over a certain value, we're going to classify this as high volatility. In between, below a certain tolerance, we'll classify it as low volatility. In between those two, we'll classify it as medium. Just a way, again, to segment the market, and that way we can look at our strategy through different lenses to understand where is it operating the best. In this example, this one's using Bollinger Bands, but there's many other examples using like ATR and many other indicators as well. One of the things when we're running filters and triggers, you're talking about the challenge of getting filters to work. And I mentioned I spent a lot of time trying to understand those intimately and trying to understand where they work best and where are they getting a lot of false triggers versus more positive triggers. The other piece that I wanted to mention is I typically am running, it's best practice to run your filters on a higher time frame than your triggers. So when I'm running these filters, I'm typically running it 3 or 4 time frames higher. So if I'm running a 5-minute chart, I'm running on my triggers, I'm going to run my filters on a 15-minute chart or a 20-minute chart. If I'm trying to trade a 1-minute chart, my filters are going to be on a 4 or 5-minute chart. If I'm trying to trade, if I'm trying to swing trade, I might have my filters on a weekly chart and I'm taking my triggers on a daily chart. So I'm always keeping my filters on a higher level time frame, and I'm working to classify that higher level time frame, saying yes, we're in a trending market, and then I'm trying to take those opportunities on that lower time frame. There's also times in some of my strategies that I've developed, I'm leveraging 3 time frames, where I've used some simple moving averages as an example to, or actually I think I used EMA on this other strategy, not simple moving average, but there's a way to classify the trend with 2 or 3 moving averages, depending on how many zones you want. And I've set up some strategies where I am classifying the trend on 3 different time frames, and I'm trying to align all of those time frames before I start to take my triggers. The more kind of filters you add, the higher the probability, the higher win rate that you're going to get on your strategies. But there's also a negative correlation with the number of trades. So your probability is going to go up, the number of trades are going to go down. For me, this isn't a problem. I'm looking for higher probability. I'm looking for a decent risk to reward. I'm trying to balance all of these components. So the kind of those correlations are typically when your risk to reward goes down, your win rate goes up. But then what I'm also trying to do, and that's I'm trying to find that balance between win reward, risk ratio, and then my profitability as well. So there's many different techniques that can be used to kind of create a base example and then kind of massage it with trade management. But that's I'm trying to balance those components in my trading. Any questions? You're muted, Hogler.
Exactly. So, as I understand it, you're kind of looking at, let's say, if you add so many filters that you only get 1 or 2 trades per day, they are high probability, and you make $200 on the day. But if you take 1 less filter, you get 1 or 2 losses more, but you get 5 or 6 wins more as well, and then your profitability on the day is, let's say, $500. And so I understand the way you explained it. So you're looking at all of that in relation, and then managing and adjusting accordingly. Yeah.
And then just to add a whole nother layer to that, I'm not just trading one strategy on one time frame. I am trading multiple strategies across different time frames to diversify. And so I'm not worried about one strategy, whether it takes a trade in that day or not, because there might be another strategy that I have in my portfolio that's taking a trade. So I'm trying to diversify in that manner as well, and we'll talk a little bit more about that in coming slides as well.
Mm-hmm.
So just another couple ways to filter the data and ways to get those insights. So through Market Jungle, there's two other filters that are pretty helpful. It's one is performance by price. So another way to kind of look at the market is by market cap, and strategies tend to perform differently on different market caps. So if you're leveraging one strategy across multiple assets, then you want to start to look at what price per share does that strategy perform best in. And so we give some insights there for that. If you're designing a strategy just for one particular asset, this might not be as important. But if you're designing a strategy that's going to span across multiple assets, then it becomes more important. The other piece is, does my strategy work best when I'm day trading it or swing trading it? Many times, day traders will close all their positions at the end of the day, regardless if their triggers have been hit. Excuse me. But this is one of those other things to be able to get insights on and to segment by. Does it make more sense to keep your strategy overnight or not? So we'll also be able to segment out, we also do segment out intraday versus multi-day trades to give that insight. So just to recap filters before we move on to triggers. Filters is to mainly segment the market. They're mainly on higher time frames. The more filters you have, the higher win rates that you're going to get, but you're going to have smaller amounts of data to be able to optimize on, to be able to back test on. So the more you filter down the market, the more historical data you need to be able to have some sort of statistical significance when you are developing your strategies. So there's a balance there as well. When we shift and we start talking about triggers, triggers are going to be on a lower time frame. There are various types of triggers for volatility, for candlestick patterns, for price action. You can have triggers for level 2 and the tape. And then you can have triggers based on these price action items, or you can have triggers based off those indicators as well. So indicators can be used for those filters or triggers. Many times my triggers are based off price action, though, not indicators. Going back towards your thought, Hogler, about many indicators are lagging. There are some leading ones, but I tend to I'm more of a price action trader than trading indicators personally. I mean, you can take your own approach, but just wanted to share where I'm at there on that one. Let's see. So we've kind of gone through this journey here so far where we've talked about mean reversion or momentum strategies. That's kind of top level of defining your strategies. We talked about the subcategories, which are time frames, types, asset classes, so on and so forth. So we want to define all of that in our strategy development process. We want to define all of those filters in our strategy development process so that we can segment the market and start to understand it. And again, this is going back to, I have an idea that I'm trying to capture in the market that I see repeating from my chart time, or I am trying to explore some anomaly I see, or whatever the case may be. It's essentially taking your thoughts, classifying it, and testing it. When we talk about triggers, again, we want to have a very clear written plan. So for discretionary traders who are not coding, it's literally writing this down in a Word document, and creating that playbook that we talked about with each one of those components when we first started out. So it's, what filters do I want to use? What triggers do I want to use when developing the strategy? And that's going to be something that provides you framework that you can measure against in the future, or you can backtest and measure the performance so that you know what to expect in the future, or have some sort of confidence. I shouldn't say what to expect, but in terms of probability, you can have some sort of confidence in that system in the future. Again, if you don't know where to start, just taking those trades and uploading them to Market Jungle gives you all those insights so that you can just upload them, see where you're at, what's working, and then start to form your strategies based on what's working right now for you, and start to do less of what's not working. All right, shifting gears to risk management. This is the next two are very large topics, and we're going to talk about risk management, and we'll talk about trade management, and I'll try to add some value and some thoughts on a few of these items as we're talking. We might not have the slides, but I'll give some ideas and ways to think through some of this stuff. So risk management is a very big piece that helps you stay in the game. You really need to stay in the game in order to prosper when trading. And there's many different types of risk management. There's many different types of risk. And so when we look at risk management, it's broken down into a few categories, and I think I missed a couple here too, but leverage is one of them. How do we use leverage properly? When do we want to use leverage? When do we not want to use leverage? So many people I know, they're looking to hit home runs, and they have a very, very small win rate, but they're looking for huge gains, and they're leveraging up on their positions, and that's the wrong way to use leverage, in my opinion. Again, to each their own, but the way I look at leverage is I am controlling my risk across every strategy. I'm managing my risk, like I showed in the first or second slide, I'm managing my risk across those strategies. And so what leverage allows me to do is it allows me to add more strategies to my playbook, but my risk that I'm sizing off is off the cash that I have, not my cash plus leverage. So all that leverage allows me to do is to diversify by adding additional strategies and additional approaches, but the amount of risk I'm taking is managed across all of those. It's not allowing me to take one strategy, leverage up my size to the moon, and hope for the best. It's just to be able to scale horizontally, add more diversification, but while maintaining my risk appropriately. So that's how I look at leverage. Again, everybody looks at it differently, so I'm hoping just to kind of spark some thoughts in your process and hopefully create some value and give you some things to think about. So some other areas that I look at when I'm managing risk is I'm not only looking at a daily stop loss, I am looking at a weekly stop loss. I'm actually looking at a monthly too, even though I don't have that on here. So I want to know where should my daily, my weekly, my monthly stop loss be, and I'm clearly defining that in my strategies and in my playbook. Someone may ask, well, how do I set a daily stop loss? And that is something that is unique to every individual, but again, I'm just kind of sharing some of what I do, and personally what I do is, since I have all of this data from my trading, I go and I manage them across my strategies. I know what my average winning trade is, and I ask myself, how many days am I okay with going into a drawdown? And if I want to recover from a drawdown in 2 days or 3 days time frame to make sure that on a week I'm profitable, then I go look at my daily average win rate, and I will use a multiple of that to figure out what my daily loss limit is, so that I'm controlling my risk over the week as well. And I typically, personally, I use 2 days for my daily stop. So I'll take my average winning day and I'll times it by 2, and I use that for daily stop. So that I know that worst case scenario, if I lose money today, it's only going to take me 2 days or even a day to make it up, depending on where I set it. So many other people, they will, from what I've heard, is they either don't have a daily stop loss, don't have a weekly stop loss. They'll keep trading, get into revenge trading because they were up, now they're down, and they want to make back what they made. But controlling that risk and having those stop losses helps you get back into uptrend in your P&L much faster. Diversification is another way of managing risk. So I mentioned that multiple time frames, multiple asset classes, multiple strategies, just another way to manage risk. And there's a whole nother topic around understanding correlation in your returns, because when you're looking at those strategies, you may be developing similar strategies where those returns are correlated. This will be a topic we'll talk about in another time, where it's looking at the correlation between your returns to make sure you're truly diversified. Emotional discipline's another item here. So if you're discretionary trading, it's part of risk management. I would say 80% of it's managing yourself and understanding your triggers and when to step away, and creating rules that help you check in with yourself and break you away from your account when you need to be. Market conditions is another one. So I mentioned like throughout the day, you have a lot of volume in the morning, a little bit in the afternoon, some more at the end of the day. And when I think of market conditions, that's one way of thinking about it. And a way to manage risk might be, hey, in the morning, I'm going to have a stop loss for the morning session, for the afternoon session, and for the end of the day session, and kind of break it down on a micro level like that, so that you can you don't hit your daily stop loss in the morning session, and you still have a chance throughout the day to kind of recover if you were to have a bad morning, and without hitting your daily stop loss, you still have a chance throughout the day to recover and get back to a profitable day. So it's something else to kind of think through. And then risk tolerance is another one. This one's important, and this is like overall account risk tolerance. How risky do you want to be? I talk with so many traders who trade smaller accounts, and because their account is small and they're undercapitalized and they're focused on trying to make money, they take positions that are way too large. When I'm sizing my positions, I am like 0.00, excuse me, I'm a half a percent roughly of my overall cash value is what I'm risking. I know people who are risking 3, 4, 5, 6% on one trade, and personally, that's not the way I trade. If you are that confident in your system, great. But what I find is it's a lot of people who have smaller account sizes are risking that much because they want that end result of making $100 on a trade or $200 on a trade, but they're so disproportionately positioned that a couple trades is going to draw them down so quickly, and they're not going to be able to recover. And that's really where Monte Carlo simulation comes in, and this whole kind of framework we're talking about here. So personally, again, I'm very risk adverse. I'm risking 0.5% on every trade, and this makes sure that I'm staying in the game. I'm sizing my positions accordingly. Every single trade before I get into it, I know that exactly what's going to be risked, and I'm managing that myself. So one big piece for risk management is Monte Carlo simulations, and there's really two ways to leverage Monte Carlo simulations in your strategy development process. So one of the great ways to use it is looking at your max drawdowns. And for those of you who don't understand what Monte Carlo simulations are, what it's doing is, if say you were to run a back test, or you have your trading data as an example, and you have 100 trades, the way those 100 trades came together to form that P&L curve is one example of what that outcome could have been. And the only way that is going to happen again is if the market and all the same players and everything are identical moving forward. And that's not going to happen. So that was kind of a one-time shot of what happened, but it's not going to be something that happens in the future, and you can't bet on that being something that happens in the future. What Monte Carlo simulation does is it takes every one of those 100 trades and it reorders them. And you can say, I want to run 1,000 simulations or 10,000 simulations of taking these trades and reordering them to see what that final outcome is. If you reorder those trades, that last value you have is going to be very different. The other piece that's going to be very different is your max drawdown. So one of the big things to look at when running a Monte Carlo simulation is, what is your max drawdown on a strategy? And the reason this is so important with risk management is because you are going to, you don't know if you had a string of, say you ran a back test, or you were doing some testing and you're looking at your results, you don't know if you would have wiped your account out or not, as an example. This is an extreme example, but say in your back test, you only had a string of 3 losing trades at one time, and that string of 3 losses in a row made you only lose $100, as an example. If you run a Monte Carlo simulation, it's going to run those 10,000 simulations, and then you can actually measure what would have been the probability of a much larger drawdown. And if I had 13 losing trades in a row and I had a drawdown of $1,000, is that going to wipe me out? Is it going to change my psychology? So running a Monte Carlo simulation, in this example on the left, on the bottom are percentages, on the left-hand side are values. And what you can do is you can say, all right, if I came up from the bottom and I look over at this point, In this example, if I ran 1,000 tests on this back test, I know there's a 5% chance that my drawdown would have been 300 and whatever, 300 and call it 300 and 300 bucks, call it, or 310 bucks. So you can look at it in percentage, in probabilities, and this is very helpful when you're trying to design your strategies to understand what is that overall risk that I'm subjecting to myself to, and it gives you a better picture of that possibility in percentage terms. There's also a percentage up here, like a 10 or 20%. I can't see because it's behind this picture here, but there's also on the other end of the bell curve that your drawdown is going to be much less. But we're looking at worst case scenario on how do we protect our account. The other way to use and leverage Monte Carlo simulations are for future volatilities. So this is something that interests a lot of option traders. And what this is doing is it's taking a set of your, it's taking essentially the stock price, and it is adding some noise into it. But then it's essentially taking those gains and returns and projecting it out into the future, and it's running a bunch of simulations. Again, every one of these lines is a possible outcome, and the intention here is to project out in time what is the potential range that that asset can be within over time. So in this example, when I ran this was a Python script that I coded. You can see here that this was where this is colored is where the data stopped, and then over here to the right hand side is where the data projected out into the future. So I could look out 20 days into the future here, and I could say this particular Monte Carlo simulation, it was showing that the range of price could fall between here and here, and the most densely it's somewhere in here. So if I'm trying to trade based off volatility, I have an idea of where that's going to be in the future. All right, risk management. So when we start to look at risk management, before I kind of get onto this, any questions there? I know that one's a kind of a little bit more advanced topic.
Yeah, those Monte Carlo simulations. So basically, if I were to, or how are they being run? If I were to load my trade protocol into the Market Django website, can I create those simulations from there, or how are they?
Yep. So this is not in Market Jungle yet, but it's on our roadmap. For you, Hogler, I know you're leveraging NinjaTrader as well, and NinjaTrader has the capability within it to run these. That's what this screenshot's actually from.
Okay.
So you have the software at your fingertips right now to be running these. After you run a back test, you can there's a way to do it. And we can talk offline. I can send you some details there to help you out if you'd like. But this is something that's super important to understand, and it will give you better confidence in your strategy, at least on the drawdown side of things.
Okay, and I mean, the way the Monte Carlo simulation is, then you probably define the parameters that are being varied during the simulation, right? Or so you're defining, okay, this and this parameter within the whole script can vary, and then evaluate the result of it.
So this is after you run a back test. After you run a back test based on so in that process, you would typically, in your case, I'll speak to, you would, since you're leveraging NinjaTrader, you would most likely be coding your strategy, you would be back testing it, you would optimize it, and then after that, you would run your Monte Carlo simulations on the back test to find worst case scenarios. And so this is something that would, it would take that back test result, and it would randomize the order in which those trades were taken over and over and over, however many times you specify, to map out this curve. And yeah, it might be worth. There's a lot to talk about with Monte Carlo, and I'm thinking it might be worth to create like a mini webinar on that alone, because there's a lot you can learn from your strategies there. But let me know. I can drop you a message with some details on how to run it, and we can talk through it some more if you'd like.
Yeah, I guess this would only come a bit at the later stage because it seems a quite complex topic. But yeah, it sounds interesting.
Um, Great. So moving forward here, when we talk about portfolio management and risk management across the portfolio, I gave the example early on about how we had triggers, filters, trade management, risk management, and this is something that when we look at our overall portfolio, this is an example of having multiple strategies, and it's an example on diversification. So when we start to look at managing a portfolio of strategies, we're looking at how do we have different asset types, different time frames across different sectors. And this is a way to manage these individually, like we talked about up until this point, and then managing them horizontally to reduce our risk. And this is where leverage comes in my opinion, because it allows me to kind of scale horizontally while maintaining the same amount of risk here on individual strategies. All right, moving on to kind of the last main component, which is trade management. There's many different ways to manage a trade and many different reasons why you'd want to do certain things. So in this example here, we're talking about various different types of trade management, and I'll dive into some of these in a little bit more detail if you'd like. So first one's kind of stop loss management. There's different ways to manage stop losses. You can have fixed stop losses, you can have parabolic, you can have trailing. So different ways to kind of manage that stop loss. And it is something I always do recommend having a stop loss, but the stop loss placement is very important. And when you're doing your analysis on the strategy, it's important to understand where that is placed, and there's different techniques that can be used to determine that. One option to determine stop loss placement is through optimization. Another kind of easier way is looking at your maximum adverse excursion, which is a KPI that you can look at across multiple trades that help you understand how far did a trade pull back and did you lose money on it before it actually went in your favor and you closed it out as a winning trade. It's one of those parameters you can use to help kind of optimize your stop loss. Another kind of piece of trade management to think through is, do I want to scale in or scale out? In the very beginning, I would suggest that trying to find edge without adding any sort of techniques of scaling in and out is important. At least that's my approach. Again, everybody has a different approach, but I typically try to figure out where do I have edge without scaling in and out, and then I apply techniques to scale in or out to create to weight my winning positions more in my favor. So personally, in some of my strategies, I will pyramid in. I don't pyramid out, but I will pyramid in where I'll take the majority of my shares at the initial trigger, but then as I move away from that trigger towards my stop, I am scaling in percentage-wise smaller and smaller and smaller, so my average isn't getting too far away from where I entered, but it's helping me to weight my winning trade more than my loser. So if I'm scaling into every single trade that I'm winning, then I'm able to, and when I get a loss, it's just that initial entry. I'm able to start to weight those winning positions, and ultimately what does that do to my KPI? It allows me to increase my profit factor is what it does. So that's just one example of scaling. There's many other ways to scale and reasons why you'd want to scale depending on the type of strategy. The one I just explained to you is a momentum strategy, but there's other ways you would scale for like mean reversion that makes sense as well. Another thing to think through is hedging, and this is something that confuses a lot of people. When people think of hedging, they think of like portfolio managers for long-term investing where they want to buy options to hedge against a position. And this one took me a while to wrap my head around. Like I knew what the term was, and I just didn't know how to apply it as a short-term active trader. And there's really kind of two ways of hedging, or a couple different ways of hedging when you're trading equities. And one of those is thinking of your trades in a series of trades. And this is something, when we talk about trade management, has really helped me out. And it's something that I have some very complex strategies that use different types of hedging, but this is just one example of hedging is the martingale system. I'm not sure if you've heard of this system, but it is a risky system, and it's only advisable to use when you truly understand your statistics. You don't want to just discretionary trade as a retail trader and leverage it, because it is pretty risky. But the martingale system essentially doubles your risk when you have a losing trade. I use a modified version of it, but the intention is, so if I knew off all of my testing that I had statistical significance of my system, if I knew off of my testing that what my win rate was, and I had confidence that that win rate was going to move forward into the future, at least some sort of form of it, this type of hedging would allow you to have a series of trades where if I had a 60% win rate or 70% win rate, I know I'm going to get a winner at some point, right? I would go look and I would see an understanding of what is my max number of losing trades to kind of understand, is this system something that I want to deploy? And based on that and kind of doing a full analysis of risk and what that would look like, it would mean that I take my first trade, it's a loser, as an example. I take a second trade. The way I size this trade is to cover the loss of the first position and to be profitable with the same amount of money I would have made on that first trade. If that's a winner, I then start the sequence over. If that one's a loser, my third trade, I'm going to size that position to cover the loss of the second trade, cover the loss of the first trade. And so when we're talking about this, it's looking at it in that sequence. And when I get that winning trade, it wipes out the losses of all those others. And then I start the sequence back over where I reset my risk back down to that initial risk value and start that sequence over. And again, if you know what your probabilities are, it's much more easy to do something like this. You can also do modified versions if you don't like the amount of risk that you're going to take on, where you can say, let me cover half of it. And so that's a way to hedge across a sequence of trades to ultimately boost your profitability and boost your max profit ratio, essentially. Again, don't advise it until you know your statistics. The other way that I hedge personally is on some of my strategies, rather than having a stop loss, I will take a hedge in the opposite position. So if I took that first trade long and I had my stop loss down here, when it comes down and it hits my stop loss, rather than just getting out of the trade and taking the loss, I will close that first long. I'll take a short that covers that first trade, and then take that trade down. If that came back up to its stop, I would flip it again, hedging those two trades, and take it until eventually it hit my target, and then I'd close that sequence out. So just some ways to kind of think through some more advanced trade management that will help you be more profitable day over day. A couple other things to think through when it comes to trade management is time-based exits. So this one's something that you can employ to help reduce your losses. And then position sizing, something that's also very important, understanding what your risk is, and then leveraging something like Kelly criteria to scale your position sizing based on your account value over time so you can follow more of an exponential curve. When we look at average hold times, this is just an example showing essentially like with Market Jungle, we have the ability to show what is your average time in a trade for a winning trade and a losing trade. And this is something that can help you understand where your average is at and what you do outside of those averages. These are two different examples. This one is showing it out of a report, and this one is showing it as a chart, but they're two different strategies. In this example right here, though, you can see on average, I am making the most money in closing out my trades if I'm holding those positions for a minute or under. So this is a very fast scalping strategy. If I were to hold this strategy past a minute, I start losing money. So one simple optimization here could be, hey, after a minute long, I'm going to start to scale out. And that way I know in the future here, maybe down here, if I'm holding it past 10, 11, 12 minutes, maybe it starts getting back in the money. I don't have that much of the chart shown here, but the intention here is I can make a decision based on the data that says I want to either start scaling out after 1 minute, or you know what, if I know over the last 60 days I'm only making money under 1 minute, then anything that goes over a minute, I'm going to just close the position based off a time stop versus a price stop. So again, kind of going back through this whole process, we talked about the types, the subcategories, we talked about triggers, we talked about filters, we talked about trade management, risk management. Defining these rules in your playbook as part of your strategy is important so that you can reference them in the future and you can essentially measure your performance against this strategy that you're developing. And the same process we're talking about is repeated over each one of those strategies within your portfolio. All right, we're getting towards the end here. I think we only got 5 slides left and we'll be wrapping it up. But one piece here is just some examples on regime filters. And again, I tried to give the examples of how to create these filters. They're typically on the higher time frames. We looked at Arun, we looked at Bollinger Bands, and the intention here is to understand and categorize your trades so you can segment them and understand how they operate in each market condition. You hear a lot about market conditions. You hear about only taking trades in an uptrend or only taking trades in a downtrend, and it took me forever to figure out how to classify the market to understand this. And it's not so much about getting those filters perfectly, it's about having a system to filter by, is really what it's about. And what I'm doing here is just showing an example of with a trend following system, you may find if you start to tag your trades and you start to filter by these conditions, you can fill out this matrix when you're developing your strategies, and you can figure out, hey, my trending strategies only work in high volatility. My long only strategies, work in uptrends when the volatility is high and medium. My short strategies work in a downtrend when the volatility is high and medium. For For a counter trend system, you may find it's reverse. You may find that my short strategies work great in an uptrend when there's a lot of volatility or medium, and vice versa for downtrend, because we're trying to find those extremes in a counter trend system. For mean reversion, you might find that those don't work in any trending markets, but they work great when in low and medium volatility markets. The last 2 pieces here are just kind of looking at that process, and there's 2 ways of essentially doing a back test. One way, for a lot of discretionary traders who don't understand how to code, they can essentially identify what all those rules are, go back in time, and go pick out those trades based on their rules. We do offer a generic input into Market Jungle where they can fill out that information and upload their trades directly into it to start to quantify all of this using the insights or the metrics. The other option is using code, and this creates a more complete backtest. Many of these platforms have the ability to do some sort of backtesting. I know you're using NinjaTrader as well, and there is some ability to backtest, but it doesn't give you the amount of data and the insights and the filters and the amount of ways to optimize as what we're doing. So this is more of a complete backtest to really view and see what's working so that you can make those modifications. So kind of that approach is to code your strategies, you output your executions, you just drag and drop that file into Market Jungle, it uploads it, and then you look at your insights, you figure out what's working, what's not working, and then that's your feedback loop, and you make those updates in your strategy, and you run another backtest. So it's a way to kind of have that approach and that full feedback loop to continually improve and kind of optimize those in a more complete way. And this is the last piece here. So the last kind of key thing when you're looking at strategies is, when is it time to make adjustments? No strategy is good all the time, and strategies come and go. So we have kind of those 2 main views, which are the insights and the metrics. These help you monitor those over time so that once you are live, you can look at things such as, I know my average and max drawdown are XYZ. I am live with this strategy. If my max drawdown starts to exceed my, in live trading, starts to exceed my max value from my historical trading, I know it might be time to re-optimize. Or my win rate starts to decline over time, it might be time to re-optimize. my profit factor starts to decline over time, it might be time to re-optimize. My max number of losing trades when I did all my testing was 10, but now I'm at 15. Well, it's probably time to shut that strategy off and re-optimize. So just kind of another way to leverage market jungle in your trading here. So that's it for the Prezo today. Any questions, Hogler?